OCI Masters Advanced Accounting. In this video, we are going to go over how to figure out certain questions for the equity method of accounting. All right, let's talk about the different levels of control before we go through this particular problem. So when a company purchases stock of another company, they can purchase different percentages ownership of that company. So if it's 20% or less, you will either use the cost or the fair market value method, and you'll adjust that asset to fair market value. When it's 20 to 50%, you will complete the accounting using the equity method. When it's 50% to 100%, you will consolidate. Always look for the words significant control. So for the equity method, sometimes it can be tricky. It could say something like the company owns 19% of another company, but they have significant control over that company. Then you will use the equity method. So be careful. If it's a significant control, that will be the equity within those percentages. All right, so let's look at the problem. On January 1st, 2021, Fisher Corporation paid $2,290,000 for 35% of the outstanding voting stock of Steel Incorporated and appropriately applied the equity method for this investment. Well, even if they didn't tell us that, we would use the equity method. Any excess of cost over Steel's book value was attributed to goodwill. During 2021, Steel reports $720,000 in income and $100,000 of an other comprehensive income loss. Now, pay close attention because we're going to do some things different when it says other comprehensive income. If it just said net income, that would be different, okay? All right. Steel also declares and pays $20,000 in dividends. Okay, so it's saying, what amount should Fisher report as its investment in Steel on December 31st, 2021 balance sheet? The investment account is an asset, so think of that. You will increase with a debit, decrease with a credit. B, what amount should Fisher report as equity in earnings of Steel on its 2021 income statement? Okay. Look over to the board. I have this base. So whenever you do the equity method, get in the habit of writing base. And then you can just fill in the missing pieces. Base will always be your beginning balance. That's in the investment account, all right? I'll also show you with a T account. Here's your debit, here's your credit. Okay. You will add the percentage of net income or the OCI income, other comprehensive income. Remember, OCI stands for other comprehensive income. You will always subtract dividends. So dividends, when you use the equity method, they must always be subtracted from the investment account. Think about it. If a company owns another company, they can pay themselves dividends. So the Financial Accounting Standards Board came up with the standard for the equity method. You must always subtract dividends. Now you'll figure out a percentage of the dividends owned, but I'm going to show you another problem where it will be tricky. You won't multiply it by the percentage, but in this case we will. Other comprehensive income, if it's a loss, you will subtract that, and then that will finally give you your final balance. All right, so in this problem, it tells you that they purchased this investment for $2,290,000. Okay, that's your beginning balance, $2,290,000. Okay, if you want to do a T account, that would be your debit, $2,290,000. Okay, next, we're going to add any net income or if they had other comprehensive income. All right, so the net income Steele reports 720,000 of net income. Stop. They only own 35%. So you're going to take 720,000 and multiply it by 35%. When you do, that gives you 252,000. Okay? All right, you will add that. You will see, if you were doing the journal entry, you would debit the investment account and credit an income statement account. But let's go over to the T, 252,000. We will add. Okay? Now I look back. What else do they have? Okay, they have an other comprehensive income loss of 100,000. Remember, take the 100,000, multiply it by the percentage owned, 35%. And when you do, that is 35,000. Okay, this is going to be another subtraction. We will next do the dividends. They only own, they gave you the total dividends. You didn't have to figure it out. They gave you that. It's 20,000, but they only own 35%. You will take 25,000 times 35%, and that gives you 7,000. You'll add these two together, but that's going to be a big subtraction. I'm just showing you the individual pieces. Okay, and that is 42,000. You'll subtract, and that gives you 2,500,000. If you did a T account, you would put your investment, you'd put a credit for the 35, you'd put a credit for the 7, and then you add those, subtract, and that will total 2,500,000. So your answer to the first question, A, is 2,500,000. Now B, here's B. What amount should Fisher report as equity and earnings of, so they're asking specifically for the income statement. This is tricky, all right? You will only include the net income, all right? The net income, well, you know that. You're probably saying that's not tricky. Net income goes on the income statement. The other comprehensive income, no. Do not put that on your income statement. Remember, that's on the balance sheet. That would show under equity, okay? So the question is, what's on the income statement? You will only answer the net income, all right? And that's it for that particular problem. I'll see you soon.